Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at two great stocks to consider buying at big discounts heading into June. And those two stocks are Lululemon and Global Payments. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look in some of our services, portfolios, and more. So before we jump into these two beaten down stocks consider buying heading into June, I quickly just want to go over the broader market to give a sense of perhaps why we're looking at these stocks in particular. I'm recording this on Thursday afternoon heading into the long Memorial Day weekend. So the NASDAQ and the S&P 500 hit new all-time highs again on Thursday after Nvidia posted another blowout quarter. After the bell on Wednesday, its stock climbed. It was up over 8% as I was recording this. The AI chip superstars revenue climbed 262% year over year. It raised its dividend by 150% and announced a 10-for-1 stock split effective on June 7th. And Nvidia really wasn't even that overheated heading into that report compared to where it was in February and some other stretches during the last 5 years. So given that big well report and everyone trying to jump into AI and not wanting to get left behind on Nvidia, it's no surprise that the stock jumped higher. And then the Fed minutes on Wednesday showed that we're going to be higher for longer, but Wall Street already knew that, so didn't really react to that too much. Many are now calling for what could be a boring March, slowly higher to new all-time highs throughout the summer as the remaining market bears wave that white flag. That said, the market is looking a little overheated in certain pockets in the near term. Thankfully, though, there are a ton of stocks at the moment that are sitting at what should be long-term discounts. So it's kind of time to think about that Warren Buffett mantra of buying stocks when others are fearful. And you see a lot of people being greedy and trying to jump into all these big names that are up, say, 50, 60% this year when everyone's kind of avoiding the stocks that are seemingly down heavily in 2024. So at the moment, there are over 150 S&P 500 companies that are still in the red in 2024, and some are down 10, 20, 30%. On top of that, 150 S&P 500 stocks, actually 200 S&P 500 stocks have lagged the market so far this year. So it's worth kind of looking for the best-in-class names out of those group of companies if you're looking for possibly some value as the market, as I said, looks a little overheated in the near term. So with that in mind, we're going to take a look, as I said, at these two big S&P 500 names that are trading at what could be really impressive valuations and prices for long-term buyers. And the first of those two stocks is Lululemon, which trades in the ticker LULU. Lululemon really did change the fashion industry in many ways, and it spurred an entire new way for people to dress, fueling Nike and Target and countless others to copy that athleisure style. The stock has, however, tumbled in 2024, and in fact, it is the worst performer in the S&P 500 so far this year. It's down 40% year to date as I record this on Thursday, heading into Memorial Day weekend. The fall came as the firm offered slightly lower than projected guidance last quarter, so when it reported its Q4 results, but its growth outlook remains stellar, and the stock looks like, in my opinion, what could be a steal at the moment. Lululemon did say earlier this week that it is implementing a new integrated design structure and announced the departure of its chief product officer. That could possibly impact the stock in the near term. That's kind of the news of the week for Lululemon, but I don't think it'll be too much of a long-term impact on the stock. What is worth noting is the company is set to release its first quarter fiscal 2024 results on June 5th. So some investors might want to wait until after that report to see how its guidance comes up. But if you're not into the exact market timing game, it might be worth considering getting into that stock heading into that report. So let's jump into a little bit of the company and then kind of more of the technical and valuation side that is as I said, screaming a buy to me. So Lululemon changed the way millions of people dressed. Everyone from Nike and Target, as I said, raced to roll out those athleisure lines for men and women. And now it's involved into a really well-rounded sportswear and apparel company. It sells a range of clothing that you can wear to the gym, the office, the golf course, a date night, really practically anywhere. It's also has now its own shops all over the world. It has its own resale shop where people can buy and sell used Lululemon. That just shows how popular that branding is You have other companies that are really popular, such as Patagonia and other higher end brands that have really strong customer loyalty that offer their own resale shops as well. It's ventured into other revenue streams as well, and it's posted consistently impressive growth over the last few years, and even in 2023, even as broader consumer spending, especially outside of say going out to dinner or traveling, that was still really big in 2023. But Lululemon kind of bucked those wider consumer trends of people not spending as much on clothing and various items because it's higher income shoppers, which are the people who tend to shop at Lululemon because its offerings are pretty expensive, just continue to buy and buy and buy. So the company posted 19% sales growth in 2023 with international revenue up 54%. This came after 30% revenue growth in 2022, 42% growth in 2021, and 16% average growth during the 5 years prior to that. It also posted 27% adjusted earnings growth last year. As I said, it benefits from customers who are willing to pay somewhat high prices for clothing, $130 for leggings and things like that, $90 for shirts. So that kind of shows the people who are buying this aren't as impacted, say, by the lingering inflation. And this came after 30% adjusted earnings growth in 2022. So really impressive top and bottom line expansion over the last few years. And with that said, the company sold off heavily after its Q4 release in March on only slightly lower than projected guidance. But I think it came down to the fact that they're not going to be growing at this 30% clip on the top line like they did and the bottom line like they did over the last few years. So people hammered the stock for that. But it's still expected to double its business from 2021 to 2026 to go from about $6.3 billion to $12.5 billion in sales. They're going to try so they've maintained this for a while. They're going to try to double their men's business, double their e-commerce business, and quadruple their international net revenue relative to 2021. And we can see that last year it did 54% international growth. So that's really impressive, along with, as I said, that 19% top line growth. And yeah, the stock got hammered even though its earnings outlook really didn't change too much. It's down about 1.5% for fiscal 2025 and about 0.4% for fiscal 2024 since that last report. So really just slightly downbeat guidance drove the stock way lower. Just, I think maybe people were expecting them to say they were going to do another 30% top and bottom line growth, but that was never really in the cards. And if we look over the last year, its outlook for 2024 earnings is still up 5% from where it was a year ago. And its outlook for 2025 is also still up about 5% from where it was this time last year. It currently lands a number 3 hold, the Zacks ranked number 3 hold, and it has topped our estimates on the bottom line for nearly 5 years running with only one miss in the last 5 years. So looking ahead, we're calling for 12% revenue growth in 2024 to go from $9.6 billion to $10.8 billion, and then another 11% growth next year to get all the way up to about $11.9 billion in 2025. And then on the bottom line, we're calling for 11% adjusted earnings growth this year, and then another 12% adjusted earnings growth next year. And this top and bottom line growth goes back to more of the days of 2021 and 2018 and 2017, and just more stable growth as opposed to some of these boom years they've had in 2020 and 2022 and 2023. So still really impressive double-digit top and bottom line growth, just not the wild growth they've done over the last few years and then at certain points before that. So the stock is up 4,600% over the last 15 years, which blows away the market. And this includes a 560% run in the past 10 years. And it's still up 72% in the last 5 years, despite its recent tumble. It's now trading below its 50-month moving average for the first time since roughly 2017. So the stock has been hit pretty hard. As they said, it's down 40% year to date as the worst performer in the S&P 500. It's currently at some of its most oversold RSI levels over the last 5 years, and it seems to be trying to find a near-term bottom at some of its lows over the last 5 years. So it's trading solidly below its 200-day and 50-day, so there's not necessarily technical support at those moving averages anywhere here soon, but it's beaten down super heavily. It's trading 56% below its average Zacks price target and around 40% below its peaks. And then on the valuation side, it's really impressive. So the stock's trading at a 71% discount to its highs at 20.4 times forward 12-month earnings, which is near its decade-long lows, right at its decade-long lows. This is a 35% discount to its 10-year median and a discount now to the S&P 500. So, as I said, 71% discount to its highs in terms of forward earnings, 35% below its median. So that's really impressive. And then its balance sheet is really stellar. It has no debt, $2.2 billion in cash and equivalents, $7 billion in total assets versus just about $2.9 billion in liabilities. So it might be worth taking a chance on Lululemon when it seems like everyone else is kind of running for the hills on this athleisure brand in company, despite its really still impressive stellar growth outlook, just not quite that same really big growth that it's done the last few years. So certainly worth considering Lululemon, especially heading into that June 5th report, as it is currently the worst performer in the S&P 500 this year. And it's just worth always kind of remembering that mantra that it's worth being greedy on some stocks when everyone else is seemingly being fearful, and then kind of taking profits on big names, say like Nvidia or those kind of companies that are up so big, or at least some profits. So just being a contrarian is a worthwhile investment strategy pretty often. And the next stock we're looking at is Global Payments, which trades the ticker GPN. It is a top payments technology firm, and the company tumbled after its early May release. Even though it maintained its 2024 guidance, investors got a little nervous, as it says its outlook continues to reflect the potential for a slightly more tempered economic environment than we saw in 2023. And then overall, a large part of its broader downturn over the last few years is that people are a little nervous about possibly its slowing growth, especially on the organic side, because Global Payments is down really big over the last few years, but this could be a really solid buying opportunity for long-term investors. So overall, the company operates three reportable business segments: merchant solutions, issuer solutions, and consumer solutions. The company's various payment offerings do everything from enabling customers to accept cards and digital-based payments to helping manage their card portfolios and beyond. It sells point-of-sale solutions, analytics, and customer engagement tools, payroll and human capital management services, and a ton of other back-end payment offerings. The firm's made various acquisitions over the years to help boost its growth and expand into different areas of the payment section. And it includes a roughly $4 billion deal to buy Evo Payments, which closed in March 2023. Overall, Global Payments is another, as I said, S&P 500 member with a worldwide reach spanning across North America, Europe, Asia, and Latin America. Overall, its growth has slowed from what was a pretty solid growth over, say, 2019, 2020, 2021. So the stock's been hammered from that. It did 46% growth in 2019, 51% growth in 2020, 15% growth in 2021. But then over the last few years, going below double digits to 5% and 8% growth. So it's been hammered for that slowing growth. We're calling for about 6.5% revenue growth this year, and then another 7% revenue growth next year. So nothing really, really low, just not the massive growth it was doing before that. So we're calling for it to go from about $8.7 billion in total sales last year to nearly $10 billion next year. And then on the bottom line, we're calling for really impressive 12% adjusted earnings growth in 2024, and then another 14% growth next year. So certainly impressive growth, especially when you consider the company has been hammered. And overall, its earnings outlook has roughly moved sideways for 2024 and 2025 over the last year, with 2025 slightly lower than the 2024 consensus. And since its last report, even though it sold off huge, its earnings outlook has pretty much remained stagnant. So it's not like it offered up really, really disappointing guidance, and yet the stock has been crushed. So overall, Global Payments stock is up about 200% in the last 10 years. This is versus the Zacks tech sector's 300%, and the S&P 500 is roughly 185%. So it's outpaced the S&P 500 over the last 10 years, yet it's trading 50% below its 2021 highs and 42% below its average Zacks price target. And it's down about 32% now in the last 5 years. But it does appear to be possibly finding some support near its recent lows. If you look at a chart, it's trying to find support near its lows of, say, 2017 and 2018, and then at various points over the last few years, it's trying to find a bottom at the moment. It is trading below its 50-week and 200-week moving averages, but it's also at its most oversold RSI levels over the last 10 years, outside of a big dip in late 2021 when it first started selling off. On top of that, it's trading at a 70% discount to its 10-year highs and 50% below its median and 65% discount to the Zacks tech sector at not just 9.1 times forward 12-month earnings. It's currently trading near its decade-long lows in terms of forward earnings, so that's really impressive. It does pay a dividend as well. It's yielding nothing crazy, but 1%. And still 74% of the brokerage recommendations that Zacks has are coming in at strong buys, with several more. So overall, 23 strong buys, 3 buys, 4 holds, and only 1 strong sell out of the 31 brokerage recommendations. So Wall Street's still really high in the stock overall. It's just come up against a few rough years. Many are worried possibly about its balance sheet. It's not the best and slowing organic growth, but global payments could turn out to be a steal at these levels. So once again, if we look over the last, say, 20 years, now 20 years exactly, the stock's up almost 800% versus tech's 615% run. So over the last 20 years, the stock has easily outpaced the Zacks tech sector. And over the last 20 years, it's now trading at its lowest ever forward earnings multiple at 9.1 times forward earnings. So that's really impressive considering that the stock is still up almost 800% over the last 20 years. So global payments, certainly another name that's been hit hard in 2024 as the wider market surges to consider buying heading into June and the summer month, as maybe more Wall Street start to look for deals, as many stocks look a little overheated in the near term. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.